chic 70s trends are in. They're here for a well-received comeback. From jumpsuits, wrap dresses to platform heels. Do you know what else has made a strong yet dreadful comeback? Inflation. Unlike corduroy and mini dresses, inflation isn't cool, so we don't want it to stay. Numerous nations are reporting multi-decade highs, including the United States, where inflation hit 9.1% in June, the highest level since 1981. Hi, welcome to the Wealth Monopoly. To start off, let's have a basic refresher on inflation. It is the increase in the price of goods and services over a period of time. Some of the highest price hikes occurred in gasoline, shelter, and food. The year-over-year increase was 41.6%, 5.6%, and 10.4% respectively. What caused this? There are different factors affecting inflation, from changed consumer behaviors triggered by the COVID-19 pandemic to international conflict. We thoroughly talked about inflation in a previous video. If you want a more in-depth discussion about how inflation really works, feel free to click the link in the description box below. Inflation is not only concerning for consumers but for investors as well. Higher interest rates are a burden to stocks. A manifestation of this is the S&P 500's dive into the bear market. Why should you care about this? In your journey to wealth, you are not just an average consumer. You plunge into the game by investing, which is why it's absolutely necessary for you to understand how inflation affects investment stocks. Central banks say that in moderation, inflation is vital to sustain economic growth. However, if it continues to hike for a long period of time, the economy will end up like burnt toast. We don't want burnt toast, right? We want it to be a perfect golden color and with a crispy crust and sweet given the center. Higher inflation by itself isn't immediately bad for stock prices. Rising prices can boost corporate profits for companies that can pass on higher input costs to their customers via price hikes. When inflation gets out of hand, its higher interest rates hurt stocks. Since higher interest rates make credit more expensive for companies and consumers, they end up discouraged from spending and investing. Inflation hasn't hurt the business performance of companies as much as it has hurt stock prices. As long as the Fed continues to increase interest rates, the stock market will continue to be hurt by this. Remember, the stock market does not represent economic conditions. It is a real-time reflection of investor sentiment and aggregate expectations for the future. A Charles Schwab survey reported that 74% of U.S. stock traders believe a U.S. recession is coming before the end of 2022. You see, the sharp decline in stock prices is mostly driven by concerns that higher interest rates would lead to a recession. How is the government dealing with this? In the simplest sense, inflation is not something to be happy about. How much more if it progresses into a recession? The government's response is to throw money at inflation in the form of an inflation stimulus check or a relief rebate on state taxes. The previous and current administration signed trillions of dollars in virus relief spending into law. The packages included 2 bipartisan bills in 2020 that pumped more than $3 trillion into the economy, including direct checks to individuals and generous unemployment benefits. Another $1.9 trillion, called the American Rescue Plan, was passed this year by Democrats after they took control of both Congress and the White House. Stimulus checks increase demand because upon receipt, people spend them quickly. The problem arises because supply remains constrained. As a result, prices rise, therefore increasing inflationary pressure. The irony is that the stimulus checks were supposed to be a solution. However, these only add fuel to the fire of inflation. The stimulus checks became a disincentive to productivity, since they already have the financial relief that is enough for them to get by. The urgency to go out and work has been dampened. Hence, the labor market slacks. Now, as a navigator on a journey to wealth, you do not want to be one of the people who have slacked off. Search for better returns. Do not rely on the help that is freely given to you. With the cash that you already have, you do not want it to easily slip off your fingers when you hastily spend it. Having that sit in your bank account isn't ideal either. If you're already in the playing field, you should not sell off right away either in fear of a bear market. Whatever currency you're currently holding, its purchasing power has ultimately weakened. Instead of hoarding your money, let your money work for you by investing in the stock market. I know that it sounds intimidating and complicated, but that's why I'm here, to simplify and to explain it to you. Historically, there are certain stocks that do better during periods of rising inflation. Now the price of oil and gas has skyrocketed. You've even considered ditching your wheels and walking to work. The question is, how does inflation manifested in rising oil costs affect your investment portfolio? Brent crude oil, the international benchmark for oil prices, and U.S. West Texas Intermediate crude oil futures both rose to their highest prices since 2008 and March 2022. This price hike was triggered by the U.S. and its European allies' consideration of banning oil imports from Russia, which causes concern regarding market supply. Skyrocketing energy prices had stocks in a panic. S&P 500 fell nearly 3% as investors worried about the war in Ukraine and its implications for the global economy and inflation. A hike in oil prices might cause the central bank to raise interest rates to help fight inflation. History reminds us that a spike in oil prices was followed by recession. The last time gas prices were high was in the midst of the financial crisis and a stock market crash. However, some experts firmly believe that won't happen today. For those who have a well-established and diversified portfolio, sit tight. If you want to take advantage of the situation by buying energy stocks, then do so with caution. CFRA, one of the world's largest independent investment research firms, expects the energy sector to outperform the market in the months ahead. Be patient and wise when it comes to building your portfolio. Watching this video will serve as your ultimate guide in investing. I hope you've been taking notes, because there's more to come. Before we continue, please do give this video a thumbs up so we will know that you enjoy the content we produce. We'll also take that as a sign that we truly have helped you on your journey to wealth. Another tip for investors is to venture into the commodities market. The 2021 Vanguard research shows that a 1% rise in unexpected inflation would produce a 7% to 9% rise in commodity prices, therefore making it a good inflation hedge. Commodities are a range of agricultural goods and raw materials. Investors break it down to two categories: hard commodities and soft commodities. Hard commodities are sourced through mining or drilling, such as gold and aluminum. Soft commodities are agricultural products like corn and wheat. In 2021, commodity exchange-traded products grew by 36.5%, while the Consumer Price Index inflation rose to 7%. An increase in demand for products increases the need for commodities used in production. As a result, commodity prices rise. Comparatively, commodities also offer higher returns. How about bank stocks? Higher inflation rates cause higher interest rates, which makes it more expensive for banks to borrow money to be lent to customers, thus hurting profitability. However, this isn't always the case. If a bank has several loans on its balance sheet, it can earn more interest income on those loans because of higher interest rates. Such was the case of the State Bank of India's share price in 2016. The inflation rate in India was around 6%. The SBI share price actually rose by about 9%. Bank stocks generally underperform during periods of high inflation, but that doesn't stop investors from benefiting from it. Investors can use the correlation between inflation and banking stocks to rightly time their investments. This can also help them decide which bank stocks to buy. Lastly, this can help them hedge their portfolios by using bank stocks to offset risk. Now, let's talk about value stocks. Value stocks have strong current cash flows that grow slowly over time. The market price of value stocks is directly proportional to the rate of inflation. So, when inflation rate rises, value stocks perform better. These stocks fare well during high inflation periods. If you're on the high-tech side and are considering tech stocks, you have to note that high inflation is a tough environment for tech companies to grow in. There are tech winners that can overcome the headwinds of inflation. So for you to be more selective, I'll be perfectly candid about the ones you can invest in. One of the resilient tech companies that have been pricing power and stable cash flow growth is Apple. It has the leverage to negotiate favorable prices with its suppliers. It can also easily raise its hardware prices to pass on its higher costs to its loyal consumers. You may also consider Salesforce and Adobe. Their subscription services give them strong pricing power in their respective markets. You've already started investing by watching this video. Remember that knowledge is a strong investment that will offer returns tenfold. Make sure to invest your time, attention, and effort in worthwhile matters that contribute to your knowledge bank. When it comes to building your portfolio, take your time and establish your risk tolerance. It's called a journey to wealth for a reason. Do not think about catapulting to success. Instead, be patient and relish in the journey. I hope you continue to invest in your growth by watching our videos. You know we are always here to stick with you in your journey to wealth. Please subscribe to our channel and ring your notification bell so that we can continue to be on this journey with you. See you in the next video.